Let me ask you, have you ever been really excited about a company's dividend promise only to find out later that their payments were simply not sustainable? Well, what if I told you for many companies there is a much smarter way to gauge the company's true dividend potential here? A method that not everybody uses, but it cuts through a lot of the financial jargon and it dives deep into the real cash flow which is used to pay dividends. So today I want to talk a bit more about this method, and I want to explore why free cash flow is a metric that you may be overlooking when you're calculating the dividend payout ratio. So look, if you're looking to strengthen your investment game, you don't want to miss this discussion. Now look, when we think about dividends, we often picture a company that's rewarding shareholders by paying them a share of the profits. But, my friends, here is the catch. How do we measure the sustainability of these dividend payments to investors? And this is where we look at the dividend payout ratio. Now, most investors look at this ratio using net income, but savvy financial analysts often prefer a more robust measure, looking at the free cash flow. So, why then do we worry about the free cash flow? I'm going to break this down in a couple of key steps. Number one, the essence of free cash flow is important. Think about the free cash flow as the true cash that a company has at the disposal after all of the obligations. It's the money left over after the company has reinvested in its business and after it's covered the operational costs. In essence, it's the real tangible cash that a company can then turn around and use to reward the shareholders with the dividend payments or pay off debt or otherwise reinvest. Number two, the reality of dividends is important to remember as well, and here is a fundamental truth. Dividends are paid in cash. They're not some sort of earnings. So while net income gives you a window into a company's overall profitability, it is still an accounting figure, and it can include non-cash items, such as depreciation. Free cash flow, on the other hand, gives you a much clearer, much more precise picture of how much cash a company really has on hand. Number three, masking earnings. Now, earnings or net income can sometimes be misleading. Thank you to the accountants and the accounting practices. A company could report high earnings due to non-operational activities, but their actual cash flow could be substantially lower. Now, if we based the dividend payout ratio purely on net income, we could simply get a very skewed perspective. 4. The sustainability factor. When dividends are backed by solid, strong, free cash flow, it indicates and shows us that these payouts are going to be sustainable in the long run. Companies that consistently generate strong free cash flows are usually going to be in a much better position to weather economic downturns without turning to dividend cuts and slashing those dividends. So, wrapping all of this up, in conclusion, while the traditional method of calculating a dividend payout ratio using net income can give us a quick snapshot, relying on free cash flow gives us a much more in-depth and often much more accurate perspective. Now look, after all, in the world of investment and investing, it is not just about the returns, it's also about making informed decisions based on the best and the most reliable data. So the next time you're looking for an investment and you are assessing a company's dividend health, remember to consider the role of free cash flow. This could just change the way that you view dividend and income investing today.